The Retail Inventory Method (RIM). This method is used by retailers to estimate ending inventory at cost. Most retailers know the markup on the inventory items and are able to count ending inventory at retail prices. Ever see the store employees counting items on a shelf? This method is used both for internal decision purpose and for financial reporting of cost of goods sold and ending inventory. It is an approximation of ending inventory valuation. Physical count is a must. This method can be used only when there is a clear relationship between the price at which inventory is purchased from wholesalers and the price at which it is sold. The retail inventory method is based on three-step calculations. A. First, calculate cost to retail percentage, that is, cost divided by retail price. B. Second, calculate cost of goods available for sale, which is beginning inventory plus purchase. C. Then you calculate the cost of sale, which is sale multiplied by step A percentage. D. Then calculate ending inventory is equal to step B minus step C. Let's look at an example. One iPhone cost $300 for a retailer to buy from a wholesaler. Retailers sell at $500. From the above steps, we can calculate. Total sales of iPhones are $1.8 million. Month beginning January 2021. The valuation of beginning inventory is $1 million during January 2021. The retailer purchases from wholesaler new stock at $500,000. Calculate ending inventory approximation value as on January 31st, 2021 under RIM. Step A. Cost to retail is equal to 300 divided by 500 multiplied by 100 is equal to 60%. Step B. Cost of goods available for sale is equal to beginning inventory plus purchase, that is 1 million plus 500,000 is equal to 1.5 million. Step C. Cost of sale is equal to sale multiplied by step A percentage, that is 1.8 million multiplied by 60% is equal to $1,080,000. Step D. Ending inventory is equal to step B minus step C. This is 1.5 million minus 1,080,000 is equal to 420,000. Cost of goods available for sale can also be derived as beginning inventory plus purchase plus net additional markups minus net markdowns. Net additional markups. This is the net increase in the original selling price. Net markdowns. This is the net decrease in the original selling price. RIM is a special cost flow method apart from FIFO, LIFO, weighted average method. Let's look at an example given below. Data for the firm using the average LCM, conventional retail inventory method. Retail inventory method is as follows. For beginning inventory, cost $300, retail $467, net purchases for cost $1,200, for retail $2,000. Net additional markups, retail $100. For net markdowns, retail $300. Sales for retail $1,700. Compute cost of goods sold. Cost to retail is equal to 1,500 divided by 467 plus 2,000 plus 100 is equal to 58.43%. Ending inventory at retail price is equal to plus 2000 plus 100 minus 300 minus 1700 is equal to $567. Ending inventory at cost. 567 multiplied by 58.43% is equal to $331. Cost of goods sold is equal to beginning inventory plus purchases minus ending inventory is equal to 300 plus 1200 minus 331 is equal to 1169. Next topic is inventory. Inventory effects are analyzed with the basic inventory equation. Beginning inventory plus net purchases is equal to ending inventory plus cost of goods sold. If beginning inventory is understated, then the cost of goods sold is also understated, everything else being the same because the equation must balance. If ending inventory is understated, cost of goods sold must be overstated, again because the equation must balance. The journal entry and reporting for error corrections depend on both the error and the period of discovery. Example: the ending inventory of year 1 is understated $2,000 because the items in one wing of the warehouse were not counted. The error was discovered in year 2. The effect of this error is shown as follows. Beginning inventory for year 1, no effect. Beginning inventory for year 2, understated $2,000. Ending inventory for year 1, understated $2,000. For year 2, no effect. COGS for year 1, overstated $2,000. For year 2, understated $2,000. Net income for year 1, understated $2,000. For year 2, overstated $2,000. Retained earnings for year 1, understated $2,000. For year 2, now balanced. This is what is meant by counterbalancing error. If it was never discovered, retained earnings automatically corrects itself, and with a new count of inventory at the end of second year, the error disappears. So the journal entry would be: inventory account, debit. To retained earnings, prior period adjustment is to the account in which the correction of an error in prior year earnings is recorded. If discovery occurs in year 3, no entry is needed because counterbalancing has taken place. All year 2 ending account balances are correct. However, both year 1 and year 2 statements should be corrected if shown comparatively with year 3. All accounts for those years affected by the error would be restated to their correct amounts.